Okay, here we are again. Uh, this is Thursday. It's 11 o'clock in the morning, and we're going to talk about equity price volatility. Uh, as you know, options and mentioned that when you buy an option, you have an implied volatility. We're going to explore that later on. Right now, we're just going to deal with actual price of the stock. And how does it work? You also can see an expectation of the volatility of the price of the stock. And some traders use the Bollinger Band, but there's another way of doing it. The calculation is based on the same. So the proportional distribution of anything, whether it's probabilities, is based on this curve that you see here. And even for lottery games, you can tell what combinations gonna come out, on what area you're gonna get combination, and what combinations of the lottery ticket is gonna be more difficult to come out of the machine. So there's math involved in that. We don't want to get involved in none of that. All we want is see the price of the stock and make money on it. However, let's say that the stock is $50, and when you see the chart, there's a way to put this to there. The way that is to get done is as follows. We can put the volatility curve that, and then we can have the chart going up and down in here. And then we can center it, the chart, we can center this into it to establish where the stock is being going and where it has been. So we're going to use, for example, that this is stock that is now, let's say, about $50. And the high that he had been, the low that he had been, it's been 40, and the high had been 60. Is we put it in relation to the price, then we can rotate it one more time, get it this way, so they'll cut the chart, so it's not proper. But actually what it would be, if we were to read it, would be 60, the high that had been is 60, the low that had been is 40, and now here's the issue. What are the chances that this stock goes from 50 to 100? Well, you can tell that it's very little chance because the curves get smaller and smaller and smaller. What are the chances of the stock going back down and reach zero? Well, it's very slim chance that the company go completely bankrupt, right? So that's what the curve turned so thin over towards zero. And that's what is the probability of the price going this much. Based on this, you can also put the volatility of the price, implied volatility on the option, and they can charge it. But right now, what we're going to do is use it with the stock. We're going to use Facebook, and this video is going to be in two parts. So right here, if we see the stock at $50, you got, because it had been there before, there's a 34% chance that it will go to 60. But above 60 going to be a little bit difficult because the lines start getting less and less toward this end. And the same thing of going down, maybe can go to 38 or 39 and then comes back up again. But the probability to go probably down to 20 was going to be very little chance. You buy an option, and the option is an a put that you expect it to go down to 20, you more likely, if the stock is at 50, you got very little chance of that option becoming in the money. Actually, this is what it's supposed to look, but to see the chart, we cannot put the chart going up like this. It won't be able to see it. So what we're going to do is we're going to move to the next picture, a slide, and we're going to see what we're talking about. Here we are. We have the probability of the stock the proportional stock price distribution. So we distributing, this is Facebook. It don't say it there. So at the time that we took this, we measured the distance from here to the bottom of it. And this is the high and this is the low over here. And we don't interested in the date, but this is about 2 days old. So it's very close to that. Now, what we see here is that when we apply this 32% here, we can determine if the option is really will be out of the money or it's too expensive and so on. But that be on part 2. What we're going to see here is that the stock, being this low, he had trouble here. It been on this price before at 260, but this time it reached 300, and then it come back down, go below 300, and start back up, and now it's tanking over here. We'll discuss another video of why this is happening, but we don't interested in that. We talk about this gap here, but this is not part of this video. So when you put the proportional distribution of the price of the stock, as a matter of fact, for anything, there's more chances that the price remaining here and that it will be a breakout. And when it break out, what are the chances to go on one direction or the other? So the chances of going right here, 15% chance that it will reach 340, from 300, but it's very slim because right now we are here. So this is the 0 point. So normally the price been traveling between these two lines, and this is the middle line. The chances of the distribution or the opportunity for the price to go down below this, you get very little less, the same way that going up is very little less, because this is unknown territory. As you can tell, if we were to go to 350, well, there's very small chance. It's about 98% chance that it will not happen. And if it will go down to zero, to higher than that, it's less than 1%. So when you add all these numbers together, 32 plus 32, this come out to 64. So we make 64% of the total spectrum of where the price is moving up and down. Now, when we take this here that go up to 340 or it goes down to 170, this is 95% of the spectrum, and then again, it's 2.5% that go below that, and a 0.99 less that it will go almost to zero. So when you add all these percentages together, they all add up to 100%. And this is how the proportional distribution work, and where more likely the price will remain. And then as the price move up, we can take a non line and slide this up or down to determine if we what more like the opportunity of the price will go up. So right now, there's other things in here that pertain to options that we don't going to discuss at this time, but we can take a quick look at it right quick, but this is not part of this video. It's just to give you a preview of what could lie ahead of it. So we go over here and we can look at options. And when we look at option, then we'll be able to determine, is this option is really priced properly? Is the volatility, the implied volatility is not within what it's supposed to be, and so on. So based on that, this is a way that you can determine where the price is going. You can determine that what are the percentage of the price moving higher. Over here, we got 32% that can go on either direction, So that means that you got 64% that this is where it be moving on it. As we establish new high and low, we can move this part here and adjust it so we can see what they coming. So when we draw the straight line at 32%, even when you were here, you could see that you could expect for the price to go from, as it was moving up, the more likely it will top out at 300. You can determine that in a ahead of time, way back over here. That 5 week ahead of time. When you saw this in here, and we've already established that it's 32%. This was not here, but we were expecting the return back to the 260 and then continue going again, and it will more likely reach out 300, and that's what it did. So with that in mind, I want to thank you for your time. This is a short video about how you do the probabilities of equities, move, and options. So on the next chart and next video, we'll be able now to study how this price and this percentage of movement of 32% actually is within what they put in on the option, and for you to determine how the price will behave on the next few weeks ahead of time. This was one of the presentations that we did for Carnival Cruise Line back in 2013. We have a seminar with Carnival, and we went from New York to Los Angeles 2 weeks on the seminar. The seminar was free, and because the seminar it was on the cruise ship, those that went to the seminar, they got the seminar for free, but the cruise ship, the expenses for taking the cruise it was tax deductible. And there's a rule on the tax law that say that if you have to travel for something that relate to your trade, and food and lodging is deductible. And it so happened that the seminar was on a cruise ship, and it was from New York to Los Angeles. So you're gonna have a vacation that can be deductible from your income tax. That's very neat, eh? He said this is what you should do. So we help people take the seminar and at the same time get a vacation on it and be able to deduct part of all of it by coming to the seminar. Whether they like the seminar or not is irrelevant. All they want is the tax deduction. So you'll have a good day, and we'll see you on part 2 later on. We upload it to YouTube. So thank you for your time. I hope that this has been some help for you, and then we do the option part on the next video. Thank you. Have a good day.